Well, it gives me great pleasure to bring on board Sunil Singhania for another edition of Markets and More, a series where we've been engaging with Sunil to talk about different aspects of markets and also where opportunity, fear and greed in this market is. Sunil, fantastic to have you back. Thank you for joining us.
Good morning.
Sunil, let me divide the market into distinct elements, the way you always look at. There is one element which is called market timing, where you look at momentum, stock picking, where you look at momentum, economy, and global cues. The second element is stock picking, where you look at valuations, the big picture, and next couple of years of what could happen to the company in this sector. So first, I want to start. Sunil Singhania, the market timer, what his view on the market is based on technicals and other aspects, and then we'll talk to Sunil Singhania, the stock picker.
I think Sunil Singhania as a market timer is a pathetic Sunil Singhania. So I don't know. But, I think what has happened, Nikunj, very clearly is that, in March, we were all as investors ruining why are we invested in equities. And come September and we are ruining that why were we not adequately invested in equities. I think that is what the fun about investing is all about. Having said that, equity market is all about one, being optimistic about the future. So unless you are optimistic and you believe that tomorrow is going to be better than today and the past, you should not be an equity investor. And second is actually there is, I would say, optimism that the future is going to be better. So as the economies open up, I think, things are coming back to normal or near normal. And that is what the market is sort of reading into it. And the second thing is alternate asset classes, the returns are falling day by day, whether it is, real estate or whether it is fixed income. And therefore, the relative attractiveness of equity as an asset class is going up. And I think the third most important thing, which is particularly true in India and also in some other countries, is that last 3-4 years, the market had become very narrow. And you were only, looking at 8, 10, 20, 30 companies which were trading at 70, 80 P multiples. Now a confluence of that realization has also a little bit of a push from the regulatory steps has meant that investors are now looking at the broader market. And there is still value. And I think that is what we are seeing as we move forward. So from a fundamental perspective, I think there is still more than enough companies to invest in if your return expectations are relatively moderate. If you're looking at momentum, maybe you will have bouts of reactions, but those reactions also, according to me, are going to be short and swift.
The general views, Sunil, with some old-timers, and I'm talking about global old-timers and some old-timers in India, is that suddenly in the world, there is no cynicism and there is a lot of optimism. Everybody believes that the worst is behind us, and that is getting captured in the way how P multiples have expanded and how market caps have got created. Don't you think as we speak, there is froth and there is greed? They both are there in the market and they're staring at us, which a lot of people are ignoring because of the price action.
Because unfortunately, the right time to buy was maybe March, April, but that time exactly opposite fear was at its peak. And you can say to some extent that there is greed. I think there is greed always. We are human beings and we are normal human beings. There will always be greed. But having said that, I think what we are also looking at is a scenario where, we have gone through one of like the century, once in a century kind of an event. And I would say that the most optimistic of the economists and investors would have written off the world for at least 2-3 years. And from there on, wherever, as I said, wherever the economies have opened up, the response of people in terms of coming back to normalization has been pretty decent. And markets are all about expectations versus reality. They are not actually the actual numbers. So if India's GDP is expected to go down by 10% in FY21, and we have a number which is 8% down, we will suddenly have, markets being very enthusiastic. So it is more about, I would say, relativity rather than the actual numbers. The other thing is we don't take into account the benefits which we have been looking at from a corporate perspective. In India, the biggest benefit which corporates as well as the normal Indian citizens would get is the lowering of interest cost. We are looking at interest cost. Short-term CDs are now available below 6% for decent companies, which were 9%. I think that is going to aid profitability. Consumers who are having mortgages are seeing good consumers are getting house loans at below 6%. The EMIs completely fall. Yes, there are stresses. There have been some job losses. We will have some salary cuts in some pockets. Economy obviously has to come back to normalization. At least in India, this constant lockdown and opening up is not helping. We need a consistent kind of a scenario. But ultimately, things are shaping out much better than what we are expecting. And I think there is general optimism that some good medicine or some vaccine should be available to mankind before the end of 2020. And I think that is also aiding optimism. So it's a combination of a lot of things, and it is all over the world. It's not only in India.
We saw a scary sell-off 2 weeks ago, at least in US tech stocks. The Apples, the Alphabets, and the Teslas of the world. Tesla is not a tech company, but yeah, it's a high-flying stock. They corrected between 5 to 15%, and Indian markets fell less. Can we start making a case for outperformance and decoupling, or it's too early or too naive for me to use that word?
In the near term, Nikunj, we are always going to be coupled and we'll move in sync. In the medium and long term, countries do decouple. I think Nasdaq by far has been the best performing equity index in the world. Even this year to date, it is the best performing. No other index comes closer to it. As I said earlier, this markets globally are now going to be volatile, which is a fact of life. A lot of news flow driven, a lot of money coming in, going out, a lot of options, derivative strategies, machine trading, quant strategies being used. And therefore, this volatility on an enhanced basis is here to stay. I said earlier, that I do expect the markets to have swift and sharp corrections. And I think that 5 to 15% correction, which you mentioned in Nasdaq, even in India, if you see, there were a few companies, particularly on the broader markets, which corrected anywhere between 5 to 15% in that 15 days. The index might not have corrected, but there were quite a few companies which corrected. So these moves of 10-15% on the upside and downside are years to stay, and investors have to be prepared for it.
Okay. Sunil, your largest holding is a technology company, HCL Tech. I think earlier this week they came out and they said, look, we expect a lot of visibility. How on the earth that is happening? I mean, the conventional wisdom is that aap ghar se kaam kar rahe ho, so that should be disruptive for technology, right? Yet technology companies have managed to reboot themselves and retool themselves. How should one read into HCL Tech commentary? I mean, do you think for next couple of years, double-digit growth for IT is back and it's here to stay?
So I'll just give you a perspective. If you take the last 10 years, the growth rate in Indian IT companies generally, as a basket, is in double digits, both in terms of top line as well as bottom line in rupee terms. Now we are investing in rupee, so we look at rupee. The growth rate is more than the growth rate in most FMCG companies. The cash flow generation is similar to what we see in the FMCG companies. But FMCG companies or consumer companies trade at a PE multiple of 80 times. And tech companies used to trade at a PE multiple of 12, 13, 14 times. Even after moving up, the company you mentioned trades at a PE of 15, 16 times. So there was always a huge value gap. Second is technology is a big beneficiary of what is happening in the disruptive world. We have started working from home, studying from home, consuming from home, entertainment from home. Anything you do from morning to evening, you need technology. And, we cannot wish away from that. The other thing is there are two sectors in India which are globally competitive. I would put pharma and chemical as one together, and IT services. And I think there we have to be, proud of it. And we also have to give them that, added, I would say, PE multiple to it. When you are working from home, technically, you're saving a lot of cost. So every single person which goes to office, the companies end up spending at least 15 to 20,000 rupees on, their tea, coffee, lunch, breakfast, transport, electricity. I think all that is saved now. I'm not talking about rent because we are presuming that the companies will not give away their facilities. But even without rent, this is a saving. The other thing is most IT companies and Indian IT companies were very adept. Within a month, almost 95 to 97% of their people had been enabled to work from home. And the other thing is that even the consumers are now pretty okay with, they're getting services as far as their providers are concerned, even if people are working from home. And US is doing very well. Europe is doing very well. Every company has a digital strategy. Every company has an IT strategy. And our view is that at least for the next 3-4 years, IT spend will in fact surprise on the upside. Now, actually, if you look at it, H-1B visa was banned by Trump because it's an election year. And despite that, we are seeing the kind of move in the IT space. Just imagine post-US elections, if things start to get liberalized, there will be an added sort of a 1-2% move in their top line, growth estimates, just because things have started to get more liberalized. So I would still be optimistic on this sector. Valuations are in our favor and earnings are in our favor.
Just to be a devil's advocate here, Sunil, IT sector is already trading at P multiple of about 20 times 1 year forward for a sector which will grow in, early double digit. That's the best case scenario. Can P multiples of 20 plus be justified for a sector like this?
So there are only two major companies which are skewing this 20p multiple. As I said, there are a lot of companies which are still available between 12 to 16p multiples, and that is where we are focusing on. Second is, Nikunj, it is very unfair that a double-digit growing sector, if it starts to trade at 18-20p multiple, you call it expensive. And, you have a whole host of consumer companies growing at 5-7%, trading at 70-80p multiple, and, you call them quality and just keep on buying them. So I think one has to be fair and one has to be, very clear of what we are getting into.
You feel that there is a lot of fear, typical time when you hunt, if you're a long-term investor, in NBFCs. Why is that?
Sorry, I didn't get it.
In the NBFC space.
Okay, NBFC.
You feel there is a lot of fear?
I think that, on the NBFC front, obviously the fear has been justified. There have been a lot of instances in the past 3-4 years in India where some NBFCs have gone belly up. Some NBFCs have faced tremendous pressure. Some NBFCs, because of their quest to grow fast, 30-40% have entered into very risky advances. And I think the whole sector to that extent has got painted with a little bit of more risk. And more than the equity side, I think funding for them on the liability side has been a big question mark. The problems faced by mutual funds have not helped either, because mutual funds were a big source of funding for NBFCs. However, having said that, I think good quality NBFCs should do very well going forward. And there are multiple reasons for it. One is most of them have gone ahead and raised capital and strengthened their balance sheet. Second is the cost of liabilities for banks have reduced quite significantly. They are still a little bit of, I would say uncertain about lending, but it's a matter of time before the liability cost for NBFCs also go down. And, specifically when we talk about, say, vehicle financing NBFCs, companies on the commercial vehicle front have doubled in prices because people are optimistic that, commercial vehicle transportation is picking up, logistic is picking up, commercial vehicle sales will do well. But NBFCs are being completely ignored. I find it very, very strange. Also, when we look at pre-provisioning operating profit, market cap to pre-provisioning operating profit for some of these NBFCs is like 3 and 4, which is like crazy, So technically, if you remove the provisioning, they're trading at like 4 times their pre-provisioning operating profit. And most of them have already provided for added NPAs in March quarter and June quarter, and maybe that will be the case even in September quarter. I think the concern with the street has is what happens after the moratorium ends. I would say that once that clarity comes in, these stocks have the potential of surprising on the upside. And I would say that one of our top recommendations from a 1-2 years perspective would be looking at these NBFCs.
I don't see too many private banks in your portfolio, even though private banks are underperforming. Any specific reason why they don't, at least the ones, the portfolio which we have, they don't figure up there? No HDFC Bank, no ICICI Bank, no IndusInd Bank, and no private banks.
No, in one fund we have ICICI Bank and State Bank of India. Unfortunately, ICICI Bank is okay. State Bank of India has been a laggard. My view is that one, corporate banks have been punished quite a lot. They should do relatively well because the stress is more on the retail side rather than on the corporate side. Second is both the banks I mentioned have good subsidiaries which are adding to their value. In fact, the largest PSU bank's chairman came on record and said only their digital business should be valued more than the bank's market cap itself. So there's a lot of inherent value there. I would say again, the same argument, the pre-provisioning operating profit for both these banks is significantly high, and compared to that, their valuations are very, very low. So we have taken a bet on the larger banks. I believe that they are the biggest beneficiaries of reduction in the liability cost. Saving rate interest costs have fallen to like 2.75%. Short-term FD rates are like down to 4.5%. And once the economy sort of comes back, and which is the case which we are building in, and once they start to lend, I think the spreads for them should be pretty decent. That those are the bets. But as I said earlier, we are banking more on the NBFCs. We are banking on lending-based financials like insurance, security brokerage companies, and so on.
Sunil, let's use the cricket terminology. Our viewers can relate with it. When it comes to pharma, would you say it's a T20 match and it's about to get over because pharma stocks are up 100%? Is it a one-day match, which is it could last for next year, 2 years, or are we in a test match for next 5 years? Pharma becomes a buy.
So I would say it's a combination of all three. Investors or traders like the T20 version. So you have some companies who will come, give you great returns and then vanish. There are some companies which will have a good story from a 3 years perspective. So, in a one day you start with a sixes and fours and you consolidate in the middle overs, and then you again have the last flurry, which is a high risk taking flurry. There will be some companies, but I think, as I mentioned earlier, two sectors in India which have global, where India has global competitiveness is pharma and IT. And I would say pharma has, strong legs to last for a long, long time. I would say this consolidation which we are seeing over the last 1.5 months, particularly in some of the larger pharma companies, is a great time to, again, consolidate and build a portfolio. There are some smaller pharma companies which are in this T20 kind of a thing, but I would say that some of the mid-sized and larger pharma companies are here for the long time, and they should definitely be looked at whenever an investor gets an opportunity. And they're not very expensive. I would put pharma again much higher than FMCG. They have similar characteristics, cash flows, and they are quite cheap.
Okay. Sunil, I just want to bring that thought out on IT once again, because you have a differentiated thought. Everybody we've spoken to, they're saying, well, post-crisis or post-COVID, you have to go digital in your portfolio. Some are buying Reliance, some are buying platform companies, some are buying both. But your view, Sunil, is that you have to bet on digital, but the best way to bet on digital is by buying traditional Indian IT companies or Indian IT services companies?
No, digital is a great theme. We love the theme. Unfortunately, we missed quite a lot of stocks because they were expensive. But unfortunately for us, they became more expensive. And, you have the India Marts of the world and the Weibo Global and the FLA and so many. So the problem for Indian investors is that there are not too many digital companies listed. And, in this respect, I would say that we as an economy have been too much liberal. We allowed the Facebooks and the Googles and the Amazons of the world to be 100% present in India. Thereby, I would say, dissuading the Indian investors from benefiting from the growth in these companies. And, like WhatsApp has been WhatsApp because of Indians. So we have to play the indirect way. And, you mentioned Reliance. I think it's a great indirect way to play. And there are others which are an indirect way of playing. So those are the new themes. But, the back end for every company, whether it is a digital company or a brick and mortar company or a retail company, is IT. And, a lot of Indian IT services companies are now quite there on the digital services side of the business. So there are companies which have anywhere between 20% to 50% of their services now coming from doing digital work. So I think it's an indirect way to play digital. Plus you have cash flows. These are not hope companies. These are not companies which are making losses. These are actual cash generating companies having good dividend yields, doing buybacks from time to time. I think most large Indian IT companies between dividend and buyback give like 4 to 5% of yield every year, which is a great yield. It's equivalent to what you are getting in a 1 year FD. So, we have to combine absence of digital with good IT companies. I think you'll have to just mix and match.
Neil, where do you think this market is completely getting carried away? It is just not paying any attention to valuations on the underlying business. It is pure momentum and liquidity which is masking people's view.
See, these bouts always happen, there is either over pessimism and over optimism. And obviously the number of new accounts which have been opened at brokerages are leading to new investors or new traders coming in. And the thing is that the first experience of these new traders has been phenomenal. And that is encouraging them to become, I would say, more brave. So somewhere down the line, you're going to have volatility. You will have bouts of, these traders also losing money. And that is how the markets will keep on getting rationalized. I think what has happened was we were in the midst of a decent correction and decent, I think, equalization. To some extent, the SEBI circular has reignited interest in mid and small cap and reignited this so-called Robinhood kind of traders. But, market is a great leveler, and over a period of time, it will level off everything. See, ultimately, the way it is said that, it's all about entertainment and entertainment in movies. In investments, it is all about earnings. So unless, earnings catch up, the valuation of any company cannot sustain, howsoever good or bad it is.
So just to wrap it up, Sunil, let me ask you a very simple question which I'm asking everyone on the channel. If somebody wants to get rich, what is the best way out?
Frankly, I don't know what the definition of rich is. If you mean rich in money terms, and if you're looking at trading and punting to get rich, I think I would not advise that. If you're looking at decent double-digit to mid-teen kind of returns, I would say that Indian equities still have the potential of doing it. And we have seen that last 3-4 years have been a little bit of a challenge. But to some extent, this last 6 months have recovered that underperformance. So you're back to at least making as much money as you're making in fixed deposits. Going forward, the assumption is that we have had 2-3 years of really challenging economy. Now we are having some tailwind. Money is available in plenty. Our foreign exchange reserves are at an all-time high. China has become the villain of the world, which means that sourcing from other countries into countries like India will increase. India and China are having issues, and that means that the government also wants to move away from importing from China, and that means supporting the domestic economy. So all those are in place. We need a little bit of push from the government and a little bit of luck. And I think we are going to head to, again, a GDP growth of 6 to 7% and an earnings growth upwards of 10-12% on a consistent basis. So, if you're contented with doubling your money in 5-6 years, and that is what is called rich, then equity investment is all about it. If you want to get rich overnight, maybe you'll have to go to a technical analyst or do something else.
Well said. Equity investing is about years. It's not about today or tomorrow. Appreciate your time, Sunil. We've done almost half an hour. Thank you for joining us on this edition of Markets and More. It's always lovely talking to you and getting wonderful insights. I mean, the key takeaway is that how to look at IT. And if consumer companies can command such strong P multiples only because of the balance sheet strength, why should IT get a step-motherly treatment?